Annexure 1, Scenario Illustration. An immersive learning experience. This annexure provides a comprehensive business scenario illustration of a company's initial balance sheet and transactions that happen during an assumed reporting period. The illustration provides the complete list of journal entries, ledger postings, and the aggregation of final account balances in the form of trial balance, profit and loss account, and finally the balance sheet. For the sake of universality, no currency symbol is used, and all transactions are assumed to be in a single currency with international punctuation for thousands followed by million. Please correlate any aspect of the solution with explanations found in Chapter 1 through Chapter 5. Scenario Illustration. ABC Limited is in the business of publishing and selling books. It has been in business for the last 5 years, and the opening balance sheet of the company is as follows. Balance sheet as of March 2017. Liabilities. Amount. Assets. Amount. Equity capital. 1 million, cash. 550,000, debt capital. 1,750,000, bank. 1,750,000, trade payables. 100,000, printing machinery. 450,000, P&L reserves. 500,000, furniture and fittings. 300,000, office rent outstanding. 50,000, inventory of books. 65,000, inventory of raw material. 35,000, trade receivables. 250,000, total liabilities 3,400,000. Total assets 3,400,000. Transactions between April 2017 to March 2018. 1. Sales of books were made for 560,000, of which cash sales accounted for 80% value. 2. A sum of 150,000 was realized from customers, of which cash recovery accounted for 100,000 and direct deposit accounted for 50,000. 3. The direct manufacturing cost of books for the period were 115,000, of which the breakup is as follows. A. Direct wages, paid in cash, 75,000. B. Direct material, 25,000. C. Direct expenses like cost of oiling etc. for machines, 15,000, paid in cash through petty cash system. 4. Raw material purchases during the period were to the tune of 20,000 and were paid in cash. 5. The average manufacturing cost of finished goods inventory of books is estimated at 20, and the average sales price realization was 80 per unit sold. Page 43 of 64. 6. The outstanding office rent was paid in cash. 7. The following depreciation percentages were applied to write off against the assets. A. Printing machinery, 10%. B. Furniture and office fittings, 20%. 8. The office rent paid through the bank clearance for the reporting period was 75,000, which exclude the value of last period's outstanding rent, which was paid in cash. But the overall rent included a sum of 5,000, which related to April 2018. 9. Interest on bank deposits for the year was 20,000, and were credited and paid by way of direct deposit on March 31, 2018. 10. The interest rate on debt capital were 3.5% per annum, paid at the end of the year on March 31, 2018, and paid by way of direct deposit. 11. Debt capital to the tune of 350,000 were paid back on maturity by direct deposit, and vendors to the tune of 30,000 was settled in cash. 12. The tax was paid at 30% on profit before tax, PBT. Journal entries. JEID, account name. Amount. Rule. 1. Cash. 448,000, debit what flows in. Trade receivables. 112,000, debit receiver of benefit. Sales. 560,000, credit income. Total 560,000. Narration. Cash is a real account type and sales is a nominal account type, so the rules are straightforward if you had keenly studied Chapter 1 to Chapter 5. Trade receivables represent the claim of the business entity ABC Limited on a set of business entities that owe money to it for having purchased books from it and not having paid yet. Since they receive the benefit of delayed payment for books already delivered, we apply the rule receiver of benefit. JEID, account name. Amount. Rule. 2. Cash. 100,000, debit what flows in. Bank. 50,000, debit what flows in. Trade receivables. 150,000, credit source of benefit. Total 150,000. Narration. Cash and bank, cash equivalent in a digital economy, are real account types and hence being debited for money flowing into them. Trade receivables are the customers providing the benefit to ABC Limited of the payment due from them. Page 44 of 64. JEID, account name. Amount. Rule. 3A. Wages. 75,000, debit expense. Cash. 75,000, credit what flows out. Total 75,000. 3B. Raw material consumption. 25,000, debit expense. Inventory of raw material. 25,000, credit what flows out. Total 25,000. 3C. Direct expenses. 15,000, debit expense. Cash. 15,000, credit what flows out. Total 15,000. 3D. Cost of goods sold. 115,000, debit expense. Wages. 75,000, credit gain. Raw material consumption. 25,000, credit gain. Direct expenses. 15,000, credit gain. Total 115,000. Narration. The entries 3A to 3C are straightforward that represent the actual incidents of booking the transaction and will be recorded on the respective dates of incurring that transaction. 3D is typically a period-end closure posting wherein the expenses directly traceable to the cost of the goods that are sold in a reporting periods are transferred to a central nominal account named Cost of Goods Sold. However, a key learning is the interpretation of the rule for crediting an expense account category for its closure. It has been called gain, and while it may appear that it is an attempt at justifying or force-fitting the rule for nominal accounts, while the overall books of accounts are maintained from the eyes of a business entity, the rules of debit and credit have to be seen from the eyes of the account. So if you put yourself in that account's position and think, the closure posting makes another account take the burden of that expense, and this account gains that amount so that its closing balance can become zero. JEID, account name. Amount. Rule. 4. Inventory of raw material. 20,000, debit what flows in. Cash. 20,000, credit what flows out. Total 20,000. Narration. Inventory of raw material and cash are both real account types, and hence it is a straightforward application of the rules of debit and credit. JEID, account name. Amount. Rule. 5A. Cost of goods sold. 65,000, debit expense. Inventory of books. 65,000, credit what flows out. Total 65,000. Page 45 of 64. 5B. Inventory of books. 40,000, debit what flows in. Cost of goods sold. 40,000, credit gain total 40,000. Narration. The cost of goods sold will have to represent the exact amount of finished goods inventory that was consumed in the sales of the reporting period. This is achieved by transferring the opening stock value of finished goods to the cost of goods sold account, and creating the closing stock value in the inventory of finished goods account out of the cost of goods sold account. Inventory of raw material is a running account unlike inventory of finished goods and hence, will have its normal life of a typical account with opening balance, transactions like material consumption, purchases giving it a closing balance at the end of the period. The only connect between cost of goods sold and inventory of raw materials is the direct materials consumption being transferred to it. JEID, account name. Amount. Rule. 6. Office rent outstanding. 50,000, debit receiver of benefit. Cash. 50,000, credit what flows out. Total 50,000. Narration. Office rent outstanding is a personal account type that represent the obligation of ABC Limited towards office landlord, as this pertains to rent of a past period where office space was enjoyed, but the payment is not yet made. Hence it represents the landlord, who is now the receiver of benefit of the payment being made. Cash is a real account type and hence it is a straightforward application of the rules of debit and credit. JEID, account name. Amount. Rule. 7a. Depreciation on printing machinery. 45,000, debit expense. Printing machinery. 45,000, credit what flows out. Total 45,000. 7b. Depreciation on furniture and fittings. 60,000, debit expense. Furniture and fittings. 60,000, credit what flows out. Total 60,000. Narration. Depreciation of an asset is the process of writing off a portion of its value for wear and tear, and is done as per accounting conventions and generally accepted accounting practices, GAAP. While depreciation is easily understood as an expense from the eyes of the assets account, since it is losing a portion of its book value, we apply the rule of what flows out. Page 46 of 64. JEID, account name. Amount. Rule. 8. Office rent. 70,000, debit expense. Prepaid office rent. 5,000, debit receiver of benefit. Bank. 75,000 credit what flows out. Total 75,000. Narration. Office rent to the extent of the amount relevant to the current reporting period is only a nominal account, and to the extent it is prepaid to cover the next reporting period becomes an asset, with a personal account type as it is a claim on another business entity, namely the landlord. So while the account is titled Prepaid Office Rent to make sense in the eyes of the business entity maintaining the books of accounts, it represents the landlord, as it is a claim on them, and hence we treat them as the receiver of benefit of having received more rent than it is due for that reporting period. JEID, account name. Amount. Rule. 9. Bank. 20,000, debit what flows in. Interest on fixed deposits. 20,000, credit income. Total 20,000. Narration. Bank account is equivalent to cash in a digital economy, and can be treated as a real account type. Even if a wider perspective is taken to treat it as a claim of the business entity on the bank, then debiting it for increasing its balance due to an income, is perfectly consistent with the personal account type's rule of being a receiver of benefit. The benefit clearly being that while the bank has received your money, it gets to keep it till a withdrawal is made. JEID, account name. Amount. Rule. 10. Interest on debt capital. 61,250, debit expense. Bank. 61,250, credit what flows out. Total 61,250. Narration. Bank account is equivalent to cash in a digital economy, and can be treated as a real account type. Even if a wider perspective is taken to treat it as a claim of the business entity on the bank, then crediting it for decreasing its balance due to an expense, is perfectly consistent with the personal account type's rule of being a source of benefit. The benefit clearly being that the bank has made a payment on behalf of the account it maintains for ABC Limited. Page 47 of 64. JEID, account name. Amount. Rule 11A. Debt capital. 350,000, debit receiver of benefit. Bank. 350,000, credit what flows out. Total 350,000. 11B. Trade payables. 30,000, debit receiver of benefit. Cash. 30,000, credit what flows out. Total 30,000. Narration. Debt capital is a personal account type representing lenders, and trade payables is a personal account type representing vendors. Hence, when they are paid, they are a receiver of benefit of the paid amount. Cash is a real account and hence is credited with what flows out. As discussed in 9 and 10, bank can either be viewed as a real or personal account type, and needs to be credited when a payment is made from it. Ledger postings. Account. Cash. Real asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 550,000 to wages. 75,000 by sales. 448,000 to direct expenses. 15,000 by trade receivables. 100,000 to inventory of raw material. 20,000 to office rent outstanding. 50,000 to trade payables. 30,000 to balance carried forward. 908,000, total of debits 1,098,000. Total of credits 1,098,000. Account. Sales. Nominal income. Debit account. Amount. Credit account. Amount. To cash. 448,000 to trade receivables. 112,000 by balance carried forward. 560,000, total of debits 560,000. Total of credits 560,000. Note, nominal accounts will be showing with a closing balance only for the sake of trial balance preparation, and will be closed off during finalization of accounts. Page 48 of 64. Account. Trade receivables. Personal asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 250,000 to cash. 100,000 by sales. 112,000 to bank. 50,000 to balance carried forward. 212,000, total of debits 362,000. Total of credits 362,000. Account. Wages. Nominal expense. Debit account. Amount. Credit account. Amount. By cash. 75,000 to cost of goods sold. 75,000, total of debits 75,000. Total of credits 75,000. Account. Raw material consumption. Nominal expense. Debit account. Amount. Credit account. Amount. By inventory of raw material. 25,000 to cost of goods sold. 25,000, total of debits 25,000. Total of credits 25,000. Account. Direct expenses. Nominal expense. Debit account. Amount. Credit account. Amount. By cash. 15,000 to cost of goods sold. 15,000, total of debits 15,000. Total of credits 15,000. Account. Inventory of raw material. Real asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 35,000 to raw material consumption. 25,000 by cash. 20,000 to balance carried forward. 30,000, total of debits 55,000, total of credits 55,000. Page 49 of 64. Account. Inventory of books. Real asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 65,000 to cost of goods sold. 65,000 by cost of goods sold. 40,000 to balance carried forward. 40,000, total of debits 105,000. Total of credits 105,000. Account. Cost of goods sold. Nominal expense. Debit account. Amount. Credit account. Amount. By wages. 75,000 to inventory of books. 40,000 by raw material consumption. 25,000 by direct expenses. 15,000 by inventory of books. 65,000 to balance carried forward. 140,000, total of debits 180,000. Total of credits 180,000. Account. Bank. Real or personal asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 1,750,000 to office rent. 70,000 by trade receivables. 50,000 to prepaid office rent. 5,000 by interest on fixed deposits. 20,000 to interest on debt capital. 61,250 to bonds and debentures AC, 350,000. To balance carried forward. 1,333,750, total of debits 1,820,000. Total of credits 1,820,000. Account. Office rent outstanding. Personal liability. Debit account. Amount. Credit account. Amount. By cash. 50,000 to balance carried forward. 50,000, total of debits 50,000, total of credits 50,000. Page 50 of 64. Account. Printing machinery. Real asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 450,000 to depreciation on printing machinery. 45,000 to balance carried forward. 405,000, total of debits 450,000. Total of credits 450,000. Account. Depreciation on printing machinery. Nominal expense. Debit account. Amount. Credit account. Amount. By printing machinery. 45,000 to balance carried forward. 45,000, total of debits 45,000. Total of credits 45,000. Account. Furniture and fittings. Real asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 300,000 to depreciation on furniture and fittings. 60,000 to balance carried forward. 240,000, total of debits 300,000. Total of credits 300,000. Account. Depreciation on furniture and fittings. Nominal expense. Debit account. Amount. Credit account. Amount. By furniture and fittings. 60,000 to balance carried forward. 60,000, total of debits 60,000. Total of credits 60,000. Account. Office rent. Nominal expense. Debit account. Amount. Credit account. Amount. By bank. 70,000 to balance carried forward. 70,000, total of debits 70,000. Total of credits 70,000. Account. Prepaid office rent. Personal asset. Debit account. Amount. Credit account. Amount. By bank. 5,002. Balance carried forward. 5,000. Total of debits 5,000. Total of credits 5,000. Page 51 of 64. Account. Interest on fixed deposits. Nominal income. Debit account. Amount. Credit account. Amount. To bank. 20,000. By balance carried forward. 20,000. Total of debits 20,000. Total of credits 20,000. Account. Interest on debt capital. Nominal expense. Debit account. Amount. Credit account. Amount. By bank. 61,250. To balance carried forward. 61,250. Total of debits 61,250. Total of credits 61,250. Account. Trade payables. Personal liability. Debit account. Amount. Credit account. Amount. To balance brought forward. 100,000 by cash. 30,000 by balance carried forward. 70,000. Total of debits 100,000. Total of credits 100,000. Account. Debt capital. Personal liability. Debit account. Amount. Credit account. Amount. To balance brought forward. 1,750,000 by bank. 350,000 by balance carried forward. 1,400,000. Total of debits 1,750,000. Total of credits 1,750,000. Page 52 of 64. Trial balance. The following rules would be applied in compiling the trial balance if the source is the balance sheet. For ledgers not having any postings in the reporting period, then accounts on the liabilities side will be recorded as a credit balance and accounts on the asset side will be recorded as a debit balance. If the source is ledger, then accounts having closing balance on the debit side will be recorded as a credit balance. Accounts having closing balance on the credit side will be recorded as a debit balance. Account name. Type. Category. Balance type. Amount. Equity capital. Personal liability. Credit 1 million. Debt capital. Personal liability. Credit 1,400,000. Trade payables. Personal liability. Credit 70,000. P&L reserves. Personal liability. Credit 500,000. Cash. Real asset. Debit 908,000. Bank. Real asset. Debit 1,333,750. Printing machinery. Real asset. Debit 405,000. Furniture and fittings. Real asset. Debit 240,000. Inventory of books. Real asset. Debit 40,000. Inventory of raw material. Real asset. Debit 30,000. Trade receivables. Personal asset. Debit 212,000. Prepaid office rent. Personal asset. Debit 5,000. Sales. Nominal income. Credit 560,000. Cost of goods sold. Nominal expense. Debit 140,000. Depreciation on printing machinery. Nominal expense. Debit 45,000. Depreciation on furniture and office fittings. Nominal expense. Debit 60,000. Office rent. Nominal expense. Debit 70,000. Interest on fixed deposits. Nominal expense. Credit 20,000. Interest on debt capital. Nominal expense. Debit 61,250. Total of debit as well as credit 3,550,000. Page 53 of 64. Finalization of accounts. Account. Sales. Nominal income. Debit account. Amount. Credit account. Amount. To cash. 448,000, to trade receivables. 112,000, by profit and loss. 560,000, total of debits 560,000. Total of credits 560,000. Account. Cost of goods sold. Nominal expense. Debit account. Amount. Credit account. Amount. By wages. 75,000, to inventory of books. 40,000, by raw material consumption. 25,000 by direct expenses. 15,000, by inventory of books. 65,000, to profit and loss. 140,000, total of debits 180,000. Total of credits 180,000. Account. Depreciation on printing machinery. Nominal expense. Debit account. Amount. Credit account. Amount. By printing machinery. 45,000, to profit and loss. 45,000, total of debits 45,000. Total of credits 45,000. Account. Depreciation on furniture and fittings. Nominal expense. Debit account. Amount. Credit account. Amount. By furniture and fittings. 60,000, to profit and loss. 60,000, total of debits 60,000. Total of credits 60,000. Page 54 of 64. Account. Office rent. Nominal expense. Debit account. Amount. Credit account. Amount. By bank. 70,000, to profit and loss. 70,000, total of debits 70,000. Total of credits 70,000. Account. Interest on fixed deposits. Nominal income. Debit account. Amount. Credit account. Amount. To bank. 20,000, by profit and loss. 20,000, total of debits 20,000. Total of credits 20,000. Account. Interest on debt capital. Nominal expense. Debit account. Amount. Credit account. Amount. By bank. 61,250, to profit and loss. 61,250, total of debits 61,250. Total of credits 61,250. Account. Profit and loss. Nominal income/expense. Debit account. Amount. Credit account. Amount. By cost of goods sold. 140,000 to sales. 560,000 by depreciation on printing machinery. 45,000 to interest on fixed deposits. 20,000 by depreciation on furniture. 60,000 by office rent. 70,000 by interest on debt capital. 61,250 by income tax. 61,125 by P&L reserves. 142,625, total of debits 580,000. Total of credits 580,000. Account. Income tax. Nominal expense. Debit account. Amount. Credit account. Amount. By bank. 61,125, To profit and loss. 61,125. Total of debits 61,125. Total of credits 61,125. Page 55 of 64. Account. Bank. Real or personal asset. Debit account. Amount. Credit account. Amount. By balance brought forward. 1,333,750 to income tax. 61,125 to balance carried forward. 1,272,625 total of debits. 1,333,750 total of credits. 1,333,750. Account. P&L reserves. Personal asset/liability. Debit account. Amount. Credit account. Amount. To balance brought forward. 500,000 to profit and loss. 142,625 by balance carried forward. 642,625 total of debits. 642,625. Total of credits. 642,625. Balance sheet as of March 2018. Liabilities. Amount. Assets. Amount. Equity capital. 1 million, cash. 908,000, debt capital. 1,400,000, bank. 1,272,625, trade payables. 70,000, printing machinery. 405,000, P&L reserves. 642,625, furniture and fittings. 240,000. Inventory of books. 40,000, inventory of raw material. 30,000, trade receivables. 212,000, prepaid office rent. 5,000, total liabilities. 3,112,625. Total assets. 3,112,625. Page 56 of 64. Working notes. Item. Notes. Computation of credit and cash sale. The total sales value for the reporting period is 560,000. 80% is cash sales, and hence the cash sales value is 448,000. Hence the credit sales values is 112,000. Computation of closing inventory of finished goods. The total value of goods in stock during the reporting period, without considering the sales, is value of opening inventory of books plus direct cost of books produced during the year. This value is therefore 65,000 plus 115,000 is equal to 180,000. The average value of the goods in stock is estimated at 20 per unit, and hence the number of units in stock is 180,000 divided by 20 is equal to 9,000. The average price realization for 1 unit of sales is estimated at 80 per unit, and the annual sales value is 560,000. Hence the number of units sold for the year is 560,000 divided by 80 is equal to 7,000 units. Hence the value of closing stock is 2,000 units at 20 per unit, and hence valued at 40,000. Cost of goods sold. Cost of goods sold is nothing but the directly traceable cost incurred in producing/procuring the units that were sold in that reporting period. The following expenses are directly traceable to cost of goods sold. Wages paid for that period. Direct expenses incurred in that period. Trading firm A, purchase of finished goods. Manufacturing firm A, direct material consumption from raw material inventory. However, when it comes to inventory of finished goods, it is simply assumed that the opening stock is fully sold, and since the entire purchases is included in the cost of goods sold, the closing stock is subtracted to make it relevant to the units sold. Hence the cost of goods sold is worked out as A, opening stock of finished goods B, plus, wages C, plus, direct expenses D, plus, raw material consumption E, less, closing stock of finished goods. Computation of depreciation on fixed assets. Depreciation on printing machinery is computed as 10% on opening book value, which is $450,000 and hence $45,000. Depreciation on furniture and office fittings is computed as 20% on opening book value, which is $300,000 and hence $60,000. Page 57 of 64. Prepaid rent. Although $75,000 was paid via bank account as rent, only $70,000 relates to the current reporting period. Hence only $70,000 is recorded against a nominal account called office rent, and $5,000 is recorded against a personal account called prepaid office rent. Hence only $70,000 will affect the profit of the current reporting period. The prepaid rent will be closed to the nominal account of office rent in the next reporting period, and hence will impact the profit and loss account of the next reporting period, since although the cash flow is in the previous reporting period, it should affect the profit/loss of the next reporting period. Office rent outstanding. The office rent outstanding gets closed as a result of a cash payout against the account. This will not affect the profit and loss account of the current reporting period, since it relates to the previous reporting period as an expense item, although the cash flow is in the current reporting period. Hence it impacts only the cash account in the current reporting period. The genesis of $50,000 credit balance in this account in the previous accounting period would have been due to a debit given to office rent account in the previous reporting period, and as part of finalization of accounts of the previous reporting period, the value of $50,000 would have gone on to impact the profit/loss of the previous reporting period. Computation of income tax. Income tax is computed by first arriving at profit before tax in a working sheet. The profit before tax is $203,750, and hence the value of $61,125 is arrived by applying 30% on this value. Hence the profit after tax is arrived as $142,625, which is the value transferred to the profit and loss reserve account. Page 58.